Broadcast is now starting. All attendees are in listen-only mode.
Morning, everyone, or good afternoon as we've just turned noontime. I appreciate you joining. Looks like we have about half of the people who signed up, so I'm going to give it another 2 more minutes and then we'll get started. Appreciate you just hanging out there for just a couple of minutes. Thank you. And as I see other people joining, we're going to get started just about 45 seconds here. We got a few more people that we're expecting, so be right with all of you. All right, great. Looks like we are going to get started here. Thank you, everyone, for joining us here today. This is the December 2020 year in review, look back at financial markets, and of course, a little preview of next year as well, which I think is probably more important. All of us are certainly looking forward to 2021. For those of you who may not know my voice or face, I'm Dave Clayman. I am the CEO and co-founder of 12 Points. And I'm happy to have all of you here today as we ring out 2020 and start to look forward to 2021. I'm joined here by my co-founder, Manny Frangiadakis. I'll let him give a little bit of himself.
Hello, everyone. Welcome to our year-end review of the markets and a slight outlook into 2021. I share Dave's opinion that we're all eagerly awaiting this year to close and looking forward to what 2021 brings and hopefully some level of normalcy. But we're here to answer any questions and provide any guidance as best as we can.
Yeah, thanks. And the chat feature does work, or the questions. So if any of you want to throw in any questions, I've already seen 3 arise here today. So we will certainly answer those as we get to the end if they haven't been answered throughout the presentation. So 2020 in review. Certainly 2020 was a year none of us envisioned anywhere in the world, I would say. The world was hit by a global pandemic, as we all know, and continues to be so, unfortunately. Economies were generally brought to their knees. We saw the sharpest drop in GDP in history in Q2, and then, of course, the sharpest rebound in history in Q3. It's a funny thing, actually, we should talk about a little bit. So we saw Q2 had a 39% annual drop in GDP. And then in Q3, we bounced back by 35.7% roughly. So a lot of people would look at that and say, geez, we're almost back to whole, because if you did the simple math and looked at 39% minus 35.7, you'd be down about 3.3%. But what you need to think about is that when something drops by 39%, you don't need 39% to come back. you need about a 50% return. So a 39% drop brings you to about 61% of activity. And then to put 35% back on top of that gets you back to about 82% of activity. So still a ways down there. Hopefully Q4 will bring us back to kind of where we started the 2020 year. Unemployment soared. We certainly know that. We saw unemployment jump up into the high teens. And one of the things we've seen is that although it started to decline, a lot of that has been from people falling out of the workforce. If you were to stay with a consistent number, unemployment, which is being quoted around 6% right now, would be about 10%. Fiscal deficits have exploded. Both sides of the aisle have certainly lost any kind of fiscal discipline they may have had. Excuse me. Over the weekend, you likely heard that Congress has come to agreement on another $900 billion package after plugging in over $2.5 trillion already. Now, some of that money is recycled. About $400 billion of it comes from leftover money from the previous package. But I think people have lost sight of how much $1 trillion is. So to give you an idea, $1 trillion, you could spend $1 million a day for 30 years it would take you in order to spend $1 trillion. It's a pretty astounding number when you think about it. Corporate profits sank. We will certainly see corporate profits down somewhere in the range of 15 to 20% by the end of the year. Interest rates were suppressed from already low levels. That was accomplished by central banks, including our own Federal Reserve, buying bonds around the world. And yet global equity soared. The S&P 500 year to date is up about 14.79%. Some of that's being knocked off today, and finds itself right near an all-time high. Friday was all-time highs across the board. The question perplexing most investors, how can Main Street and Wall Street have this large of a dichotomy? It is a really good question. We've oft heard that the market is not the economy, and while that's true, they usually at least rhyme, and we've got a pretty differing set here. So what we'll cover overall today: market returns, asset classes we are bullish or bearish on, trends we see developing, and then maybe how to protect your wealth when markets are at an all-time high.
Fantastic. To Dave's point, yeah, markets are up globally, at least in the US. S&P 500 around 14.8. We wrote this about last week, which is why you'll see the markets about 15.3. We have experienced some level of volatility as of recently, but that's normal. I mean, we just, to hit the nail on the head again, we are in the middle of a pandemic, yet we just experienced one of the best Novembers in the history of the stock market, and particularly in the last 30 years. So a lot of investors are perplexed on how could things be so dire on Main Street, yet corporate profits down and stocks at all-time highs. And what you have going on right now, and I think something we want to allude to all of our audience, is that you have two very, very powerful forces going on right now. One, you have the powerful force of a pandemic, a recession that was brought on globally by not a financial matter that is usually what has routed markets in history. This was not a financial matter. So this was a global pandemic that we didn't have the means of fighting until we had an effective vaccine or treatment, therapeutic of some sort. So you have the powerful force of the virus, but yet at the same time, you have the powerful force of zero interest rates, all-time liquidity, and central banks printing absurd amounts of money on a daily basis to pump back into the system, which is why you have markets bouncing. I mean, the idea of financial support, whether it's fiscal or monetary, is a massively powerful tailwind. So that's why you're seeing markets actually appreciate in this environment. Now, the question is, how long can this scenario last? We've always been taught, and especially in economic classes and business school classes, that the market is a forward-looking mechanism. Now, as an investor, one of the things that perplexes me is that when we were sitting at 2018 all-time highs, where was the forward mechanism looking then? And then did we really look forward 2 years out in this past March and say that this was no longer going to be a problem and that deficits and debt wasn't going to be a problem? In our opinion, we think that deficits and debt are a governor to growth, that eventually they will matter, and eventually valuations will matter again. But as a quick recap of the previous year, you have the US markets roughly up about 15%. Europe was down slightly at about 2.3%, and emerging markets continuing another couple-year trend of appreciating about 8.5%. And as you can see, we threw in some charts there, so you could take a look at how the rest of the world has lined up with the US market. For the last decade, US equities have outperformed the globe. We are of the opinion that theme could slowly be transitioning to other parts in the world. We'll hit on it later, but in particular Southeast Asia. And we're also going through a cyclical rotation of growth equities to value-oriented equities.
So a little bit about global asset class performance. So private placements. So this may be something you don't hear a lot about, but private equity, those are returns that generally outpace the public market returns. They're normally reserved for accredited investors or high net worth individuals. So what's an accredited investor? Someone who makes more than $200,000 a year or has more than $1 million in liquid assets. That's usually what it takes to get private equity. Why are the returns higher? Typically, they're paying you for the risk of a company that is newer and for the fact that your money is normally tied up for multiple years. Private lending, so available through mutual funds or private placements, also normally reserved for accredited investors, but if you're a client of ours currently on the wealth side, it is likely that you have exposure to private lending right now, lending to smaller companies, private companies, not your Pfizers, Apples, Netflixes of the world, but companies that you'd see on Main Street. And why is that? The rates are preferable. There's more attractive opportunities for us. And by not being a public loan, it likely hasn't been overpriced based on the flood of liquidity from the central banks. And then lastly, real estate, investment through public REITs, or again, if you're a client of ours on the wealth side, likely a private real estate investment firm. So we've had exposure to those areas and they treated us well in the downturn in March, and they continue to do their job in providing steady, not less volatile returns throughout the year.
One point that I want to touch on there, Dave, is the reason why you won't see asset class performance there is that these investments generally don't mark to market, meaning that on a daily basis, like your equities, your mutual funds, they don't rebalance towards the end of the day, giving you a final quote. So these are usually quarterly liquid, which is why they don't mark to market. So we just wanted to touch on that point, that it's not something you will be checking on a daily basis and seeing, how did my real estate fund do? So continuing with the global asset class performance theme, obviously a great percentage of our portfolios obviously incorporate some fixed income products. Most of the time they are in investment grade corporate bonds, government bonds, municipal bonds, and a little bit of high yield. So as the year ends, corporate bonds appreciated about 9.24%. A lot of people thought this was the year of stock markets, of stocks, but for a better part of the year, bonds actually outperformed stocks. And granted, that was a fear trade. Granted, that was a lot of uncertainty around economies given the pandemic, but nonetheless, it's a powerful message on why you need a diversified portfolio. You definitely don't want to be checking your account and seeing everything move in the same direction on any given day. You want things appreciating and depreciating on any given day, so that way you understand that you actually are diversified. Going down the list, government bonds about 8.53% and municipal bonds 5.17%. The major theme here with bonds is going to be, as we sit in all-time low interest rates, and you can see the yield right now on the 10-year Treasury. At some point, do we start to see a steepening in the yield curve? Do rates start to rise, and does that cause bond prices to depreciate? As those who can remember, as yields appreciate, bond prices decline, and vice versa. So it is an interesting theme that investors will take a look at. Do we stay at all-time low interest rates for the next decade? Do we have a spike in inflation that you could see right now on the long end of the yield curve coming sometime within the next 1 to 5 years? Does that change Fed policy? So there's a lot of interesting things to contemplate when you're looking at the world of fixed income, but generally another very strong year for the bond market.
Yeah, certainly an amazingly strong year with the interest rates where they were, and to be thinking about where does the world go, and investment grade corporate bonds, to see that return and think about where we were back in March when we were concerned about corporations and their bonds, or the market was concerned, not we. It's really truly an amazing comeback, almost as amazing as the stock market itself. So Commodities, quite the disparity in returns this year. Gold up 23.68% year to date, and still one of our favorite asset classes. We do believe that gold is an important part of one's portfolio, both the gold itself and the companies that mine for gold. It really is astounding that in the last month, with uncertainty, we've actually seen greater returns in stocks and bonds and many things than gold. And typically, asset classes that go up when the US dollar declines have gone up, except for the price of gold. And oil down 19.6% year to date. This was the year that will always be known as the one where oil actually turned negative back in April on expiration day. The futures price for oil actually turned negative, as you can see kind of in the middle of that chart there where the purple line really plunges. And demand is still down, still significantly hampered as mobility is slowed in the country due to the virus. I think it will take some time to recover, but eventually a number of the companies that went out of business this year that were not able to sustain themselves at these oil prices will cause a lessening of drilling, therefore a lack of supply, and when demand does recover, likely means higher oil prices going forward.
Obviously, those who are involved in the crypto space will also have noticed that Bitcoin has jumped significantly and is back to close to an all-time high. So similar theme to gold and the commodities market there, things that that aren't correlated to what we call the paper market. So signs of overheating. We have talked about the fact that we believe that markets have been overvalued during different periods of time. Right now might be the most important period, or at least the most overvalued that we've seen for a long time. What you're seeing in front of you is a valuation metric that investors use to evaluate whether a stock is expensive, cheap, or right down the middle. If you take a look at the valuations, most are in the 100th percentile, and you have four in the 98th, 97, and 91%. This has been the most expensive market in history. So going down a few, because I'm sure some people won't understand what this means, but medium earnings valuation to sales metric, 100%. US total market cap to GDP, 100%. Earnings valuation to free cash flow, 100%. Medium price to sales, medium price to book, both 100%. Medium earnings valuation to EBITDA, 100%. The theme here is that no matter what valuation you are using to assess whether a stock is cheap or expensive, they're all hitting the most expensive they've ever been. One of the things you'll hear a lot about, whether you're listening to the financial media, is whether or not a price to earnings valuation is in line. To give you an example, right now, Apple, a company that most people are familiar with and use their products, is trading about 44 times earnings. The way that metric works is that number is the number of years you're willing to pay for that current earnings valuation. So that means if you were to buy Apple stock today, you are willing to pay 44 years of those earnings. When Steve Jobs was running that company, that valuation was 11 years. It was 11 times earnings. So slightly different compared to history. And most of the time, when we've reached levels of valuations of this magnitude, it's usually been towards the end of a bull market, towards a cyclical top. Now, we're not predicting that a bear market starts in 2021. We certainly have a serious amount of fiscal and monetary policy coming to the table. So that should continue to keep markets buoyant, but it is extremely prudent to understand where we are from a valuation standpoint.
Yeah, I think one of the things that I've always preached is that people think that they make money based on where they sell an asset, but it really is about where you buy an asset. I saw a great piece over the weekend that said that if you bought the NASDAQ in March of 2000, right before the 99-2000 crash, it took you 15 years to get back to whole. And by now, these last 5 years have been so good that you actually would have brought yourself back to a 4% average return over those 20 years you held it. But it took you 15 years to get back to whole. Now, if you bought that same market in December of that year, your return over those 15 years that took you back to whole was almost 7% a year. So it gives you perspective as to how important it is when you're buying things. So just being mindful that you always have some cash available to take advantage of opportunities. And certainly, if you've ever heard me speak, you've certainly heard me talk about that before. So sector outlook, assets that we are currently overweight or underweight from our standpoint. Current asset allocation, U.S. equities, we're overweight to value right now. Manny talked about the potential that the cycle has finally turned where value will start to outperform growth. We have a question on that. I'll talk a little bit more about that later on. Gold, I mentioned it before, one of our favorite asset classes. Emerging markets, it appears that the US dollar has moved on from being the reserve currency of the world to potentially being a funding currency for all trading. So with our deficits, with our debt, it appears likely that the dollar's decline has only just begun this year. And as of Friday, we were at a 6-year low for the valuation. So when the US dollar declines, emerging markets typically peg their currencies to the US dollar. Declining currencies for them allow them to export more, and they are export markets. So a huge opportunity for the emerging markets potentially. Private placements, I talked a little bit about that as well. Certainly reach out to us if you have questions about those. We like those a lot. And then alternatives, you've heard me say before, that's a tough name because it refers to everything, but traditional stocks and bonds are, to Manny's point earlier, extremely overvalued by historical measures. Now, the world could be different this time. Perhaps buying a share of a company's future earnings is not what we're doing in the stock market anymore, but I always found those to be the most dangerous words on Wall Street. So I'm going to assume that reality returns, and therefore I think alternatives have provided us a good opportunity to get a steady return, less volatile, and give us an opportunity to wait for those times when we can buy those traditional assets more prudently. Underweighting U.S. equities growth. Manny talked about Apple as part of the TFANG, but TFANG being Tesla, Facebook, Amazon, Apple, Netflix, and Google. Their PE ratios are off the charts. Some of them don't even have E as in earnings. Tesla as an example. So obviously probably one of the best performing stocks now in the S&P 500. I can say that this year. I bet it's the best as it went into the S&P as of the open this morning. A company that as of 2 weeks ago was valued at the combined valuation of every car company in the world except for Toyota. So the way I looked at it, I could buy Tesla or I could buy every other car company in the world except for Toyota, including Ferrari, Honda, everything. And which one do I think turns out better? I think that turns out in favor. I'll take the field over just one company anytime. So thoughts on that?
All right, so moving on. So we know we have a fair amount of participants on this call that are that work with us via a 401k plan or corporate sponsored retirement plan. So we did want to talk a little bit about target date funds, since a great deal of people in the age group of mid-20s to mid-40s are probably, or later, are probably involved in the target date fund series. So what is a target date fund? A target date fund is a fund that uses a pendulum as a mechanism to allocate to stocks or bonds. The further out you are from that target allocation, let's say you are in your mid-20s right now and you're not expected to retire for another 40, 50 years, your target date fund could be anywhere between year 2060 and year 2070. The further out you are from that retirement year, the more aggressive that allocation is going to be, to the tune of 80 to 90% stocks. The closer you get to the retirement year, that pendulum is going to swing and slowly change your allocation to get you more conservative. And as you eventually get closer to that target 2065 year, you will be much more conservatively invested, because it's going to say, hey, participant, you are getting close to your target retirement year. Time is no longer on your side. The allocation is going to change on your behalf to get you more conservative to meet your risk profile, because one of the biggest factors of risk profile is time. The last thing you want to do is, as you're getting ready for retirement, is take a massive drawdown in your account and then say, well, I'm massively underfunded because I was expecting the market to be 30, 40% higher than where it is right now. So we just wanted to touch a little bit on target date funds. It's one of the most frequently asked questions that we get. Are they conservative? Are they managed? And one of the other things that we will tell you is that if you are a younger investor, it's probably one of the most powerful tools to your disposal. It's a very cheap costing investment that's going to have a high degree of allocation to the stock market, in particular those companies that millennials and young investors want to be involved in, your Facebooks, your Netflix, your Teslas, your Googles, these very growth-oriented companies.
Just to be clear, as he said that, they want to be invested in it. I'm not necessarily saying they should want to be invested in it.
Right. Well, they use the largest portions of the index, and that's what we're getting to. It's going to be allocated to the top companies in the index.
Sorry, that was regarding the specific stocks, not the target date fund. Sorry, thank you.
Yeah.
Trends we see developing for 2021. Certainly the future is always uncertain, but we have an idea from capital flows and asset valuations where we might like to be in 2021. So as Manny mentioned earlier, Southeast Asia is likely to outperform global equities for the next few years. Their demographics work, the currency should be working in their favor. All those things should come together. Tech will continue to outperform, and they have a very strong base in tech, so all those things should come together to help there. Europe begins to catch up to the U.S. equities. So certainly, as we pointed out earlier, the U.S. market up about 15% year to date, with Europe down 2%. That'll be something to watch, that we believe that, again, markets will come closer together since it is a global economy. Gold and Bitcoin continue their outperformance. The dollar decline is just beginning. Certainly agree with that in the dollar space, the gold space. Bitcoin, it looks like a trend. We shall see. It's certainly going to be subject to massive volatility and correction. So, again, be mindful of when you're buying. Emerging market equities and credit will benefit from the dollar weakness, as we mentioned. Government bond spreads hitting new lows. So it appears that the difference between a 10-year and a 2-year bond is going to remain compressed for some time. The Federal Reserve is going to do their best to keep that. If inflation remains under control, then that will be the case. It will be interesting to see how the Federal Reserve reacts, to see if they try to force interest rates lower if inflation starts to take hold and yields rise. The search for yield continues in the United States. I remember the time when municipal bonds paid 8%, and I'm not that old. 8% tax-free was a nice number. We certainly don't see that anytime soon. So people are forced to really hunt for, where can I get safe return in these markets? And there's an old saying that more money has been lost in the search for yield than at the point of a gun. So be cautious in your search for yield. Typically higher yielding things are there for a reason. I'll particularly mention high yield, what we call high yield debt, is at its tightest spread. In other words, its lowest interest rate versus government bonds in history. So be cautious, be mindful. We're here to have conversations about that if they arise. Whether you're talking about investments we manage or something else we can help you with, we're happy to do that. And then U.S. equities overvalued by 20%. I would certainly say that's a fair assessment if you look at history, and whether that will matter in 2021 or not will be to be determined. But we, again, with the importance of when you buy things as opposed to when you sell them, the opportunity to be patient and buy things as they arrive. Great example, just in the last month here, Pfizer announced their vaccine on November 9th. The stock hit $42. Even though they're one of the leading providers of the vaccine, the stock is back down to $37 a share, below where it was when they announced their vaccine. It's a difference, $5 a share. That's a difference buying something 12.5% cheaper than it was just a few weeks ago.
It's a great point. So what can investors do in an environment where we're sitting at all-time highs? There's massive uncertainty around the world regarding the pandemic, around deficits, around growth rates. So what are the options that investors have to their disposal? So number one, we always like to focus on assets which have not outperformed in the last 2 years. Frankly, normally things revert back to the norm, even if they've underperformed slightly. We were early to the game in 2020. We actually started that value-oriented theme. We had seen value equities getting beaten down pretty aggressively over the last 8 to 10 years. And it was our opinion that with the slight rise in interest rates in 2019, that it was probably time for value to step up. And most notably in the third quarter, you drastically saw value outperform growth. So that's just an example of what has worked versus what hasn't worked. Dave's point earlier that the four most dangerous words are "this time is different." The other thing you could do is start to limit your exposure to U.S. equities through diversification. We talked about you not seeing your portfolio go up in unison on any given basis. So diversification is key, and probably remembering the fact that markets can go down. I think that a lot of investors are children of the bull market. Essentially, equities have done nothing but gone straight up over the last decade, and I believe that's going to be a weak point for investors when they materially probably over risk and extend their skis in an improper time. The other thing you could do is buy gold. It's not only a hedge against inflation, but it is a protection of your wealth. With the dollar declining, it's a great way to protect the assets that you've built up so far. And at the same time, the dollar is going to continue to decline. Just from the standpoint of our deficits and the amount of dollars that we're printing, it's almost theoretically going to be very hard for the dollar to rise without a massive fear spike. But even in March, it was the first time that you did have a fear trade come on where the dollar didn't appreciate. That was a signal of a changing of the tides. And the other thing you can do is utilize option contracts. If you have a highly concentrated position in one of these very growthy companies, let's say it's Netflix or Google or Facebook, but you don't want to sell out of your position because you still believe in the long-term ramifications and want to be a holder for the next 2 to 5 years, use option contracts to, one, create income for your portfolio by selling a call option, whether it's once a month or once every few months. Take in that income and then build some defense, on the back end. Should the position slide against you, you could always, execute the option or let it expire worthless. So there's multiple different tools that you can use to hedge your portfolio. One of the ones that we didn't put on there is the VIX option, which is just the buy volatility. Now that is a decaying option. It doesn't tend to work a great deal unless you time it perfectly. But again, it is another option. So you would profit if you bought the VIX and the markets declined in the near term. Another way you could utilize diversification or at least a hedging strategy. And we're happy to create different defensive mechanisms and hedging strategies. So we're here to create a custom allocation for you to be able to build defensive mechanisms around that allocation. So please reach out to us with any questions. We're here to help.
And the one thing I'd add is on the right-hand side of that slide there, talking about allocations, a key driver of portfolio performance and protecting your assets. Allocating the appropriate sector is more important than which specific investment you own. So kind of being in the right theme tends to matter more than any one given company. And then, as Manny mentioned, how can we help? So our contact information here, for some reason you don't have it. Quite simply, I'm Dave at 12points.com. Manny's Manny at 12points.com. Our phone number there. And we're actually really excited about January's webinar as well, taking place January the 26th of 2021. Things that happen to you with a special guest from Neuberger Berman. So things that happen to you, life events. It's going to be all about things that you should be thinking about as certain life events come up: marriage, divorce, death, change, kids going to school, all those different options. So very excited to have a guest from Neuberger Berman joining us for that webinar, and we hope you'll join us as well. I did want to mention the questions that we got. So we touched a little bit on them, but I'll go over them. One person asked what the most concerning facet of the market is currently. I think it's the lack of fear. It is the absolute confidence. I can tell you that I had 3 different people last week tell me that they were addicted to either growth in their portfolio, or trading. And I counseled to say, one, that scares the heck out of me because I haven't heard that 3 times since probably 99, 2000, but also explaining that being addicted to anything is such a bad idea. So certainly having that relationship with your portfolio is not good. So hopefully that's something. But if you look again, that for a high yield bond, when we refer to high yield, that's also usually a reference to a junk bond, a lousy credit. And if you think about it, those are trading in the 4% range. Think about giving company money to a company for 10 years that you would call junk and charging them only 4% interest. You could barely get your, a couple of years ago, you could barely get your mortgage at 4%, and your credit probably isn't junk. So think about that idea. So those are the kinds of things that scare me. There's just an overconfidence in the world, and that concerns me. I want to put my money at risk when the odds are in my favor, and I think a lot of the time right now the odds are against you. So just being very mindful and cautious about that.
Dave, I want to real quick, if you don't mind.
Go ahead.
The other thing that is fascinating is that when you look at the year in review, the average Wall Street analyst going into 2020 had a price target on the S&P 500 of 3,200 a share. We're sitting at 3,700 a share, and we had a global pandemic. And we've already talked about how fast corporate profits drop and what it's actually going to entail for them to come back and meet their 2019 numbers. So it's a very peculiar time where you could have had the best of the best unfold compared with our 2019 comparison, yet the exact opposite happened. Yet the market is 500 points higher than what every analyst had projected as the year-end outcome. Just want to leave that as thought, because it shows you how irrational the market could be, even during the most, what would seem clear times. A global pandemic hitting, markets getting brought to their knees, corporate profits dropping. You would expect a recession of global magnitude, but clearly the opposite transpired.
And you actually did get a recession of global magnitude, just not in valuations of the market. And again, that's largely funding from the Fed that's caused that. Another question that came up was, what's favorite area of fixed income? We like a small allocation to emerging market debt. Again, that dollar funding being an opportunity there. I still like an allocation to preferreds. I think that even though they're long dated assets and a spike in interest rates could cause them some problems, I think that the higher interest rate you're getting is worth it. Most other areas of fixed income are pretty tough right now, a little bit in convertible opportunity, but other than that, it's a pretty tough run after the latest, after the great year we've had. And then lastly, I think we've talked a lot about value has underperformed growth, so there is still opportunity in value, I believe. There's an old, there used to be a school of investing called GARP, growth at a reasonable price. And then there were GAAP earnings, generally accepted accounting principles. And I think somewhere, my joke is that somewhere people got confused and they started doing GAAP to price, and it was growth at any price. That's how desperate they were to get growth stock. So I think the growth stock theme has been quite priced in, and I think the opportunities that will lie going forward will be in those value areas, even if they're slower to come around. So good, safe way to continue to grow assets consistently, in our opinion. Any last thoughts, Manny?
No, I think you did a great job summing it up. I will just, leave everyone with this. We are here to help. So please reach out with any questions, whether it's us or another one of our team members. We'll do whatever we can to assist you with whatever you're looking to accomplish.
I just saw one last question before I let you all go. Someone asked, I'm 60 to 70% invested in the equity market. What will be your advice for 2021? Move to what? I don't know if that means just US market or how it is, and I don't know your personal situation. I would say, depending on age, depending on how broadly diversified that equity exposure is, it may be fine. I would just say reach out to me directly. Again, that email, dave@12points.com, and I'll be happy to give you a little more personalized advice, but that's really too personalized a question for me to answer broadly across everyone here. So I'll thank everyone for their time. I'll wish you all a happy holidays. May you enjoy the rest of 2020. I know it won't be a normal holiday season, but really looking forward to 2021, and may that bring us all health, peace, and enjoyment for going forward. Thanks very much for your time, and hope this was helpful. Have a great day.
Be well, everyone.